Welcome to A Day at DPL, the thought leadership series of the Advisor Revelations podcast. In this episode, DPL founder and CEO David Lau is joined by Galen Schaefer of EOS Ventures. Tune in as they discuss the macro forces reshaping retirement, from solving the income challenge for 70 million Americans retiring this decade to why the next frontier of holistic advice must bridge the gap between investment management and sophisticated insurance protection.
Hello, Galen Schaefer. Welcome to A Day at DPL podcast. I'm so happy to have you on. This will be nice to have a conversation where I get to lead the questions for a change between us. Galen is with EOS Ventures, who's one of the investment partners of DPL. And welcome, Galen.
So glad to be joining you here, David. Thanks for having me.
Terrific. So we generally have an audience, of lots of financial advisors and some, individual consumers. And, one of the things, they like to hear from our guests are, forward thinking and, forward looking thoughts. We have a reputation of being innovative and, at the forefront of different things. And as a, venture firm, you're also kind of at the forefront of a lot of different things and seeing a lot of different businesses and deals. And so maybe you can just start with, what about DPL kind of spurred the interest in the investment, and what trends do we fit into in a grander perspective that you think are really interesting?
David, that's a great question. Maybe let me start by sharing a little bit more about EOS.
Perfect.
And then I can also give you a bit of context on my background, which I think will help locate this discussion for the advisors who are listening.
Yep.
So EOS, we're an early stage insurance specialist venture capital fund. We invest across, think traditional insurance, so personal, commercial, life, supplemental health, major medical. And we also invest in adjacent areas, so wealth and retirement, cybersecurity, employee benefits. So we have an appetite both in sort of direct insurance solutions, as well as sort of the adjacencies that surround the insurance ecosystem. So DPL's always sort of been on our radar as one of the foremost players in the annuity segment. One of the ways in which RIAs are really able to access fee-based annuities sort of uniquely. We're a team of 12. We're spread out across London, New York, and Los Angeles. All of us come from the insurance sector. On my side, I actually started my career at HBS doing research for their strategy division, largely on the insurance sector. Picked up my MBA at MIT. And then I was in McKinsey's North American insurance practice for nearly 5 years. So I worked with a lot of the major life and annuities players, worked with a lot of big asset managers. And so, have been sort of deep in the retirement, longevity, and income protection space for a number of years.
Yeah. And when you say HBS, you mean Harvard Business School?
Yeah, I do.
That's great. Just for that clarity, for those who may not have made the connection, which is always valuable to founder and entrepreneur, that you've got experience on the business side. So not only doing like research, at your time with HBS, but really at McKinsey, spending time in those roles, supporting insurance businesses and adjacent businesses from the actual operational side, which is fantastic.
I'm not sure if people remember this, but from the advisor standpoint, I was actually working with a lot of the big life and annuities carriers before and during COVID. I don't know if you remember this, but e-signature was such a debate in the industry.
Yeah.
Because people wanted to have that touch point of a wet signature. And then suddenly it was just such a battle inside carriers because of the paperwork it created, but they still wanted to respect the advisor relationship. And so it was never sort of high on the tech roadmap. And then COVID hit and suddenly everything ground to a halt and everyone had to sort of just lean into that really fast. And so it was fun sort of seeing, how the remote life has sort of changed the technology landscape quite rapidly compared to what used to happen.
Yeah, that's incredible. You just even forget about it, right? I mean, it just seems like one from the beginning, like, why would that be a problem? Like, wouldn't you do, everyone's doing e-signature. I mean, that's one of the things, we kind of have to drive in the insurance, in our world, the annuity industry, not a lot of great technology and process. So we have to drive a lot of it with carriers and things that seem so simple and expected in other aspects of your life, like having e-signature on just about anything would be a given. And I guess grateful in a way that we experienced remote work to have to drive innovation in the insurance world.
Yeah, it's certainly an interesting industry to be operating in. Maybe the final thing that's helpful for your listeners to know is that most of the investors in our fund are large carriers and reinsurers. We have a close strategic relationship with them. And so when we're thinking about, the insurance landscape, trends that are happening, it's not just sort of us sitting in an office in Silicon Valley thinking big thoughts about tech. We're sort of actively out in the industry talking with the carriers and reinsurers that we know about what growth looks like, who's really moving the needle, what they need to reach the next level of sort of product development, and how they can best serve their policyholders as well as their agents. And so we think that's important, staying close to the industry as we invest in the industry.
Yeah, that's great. That's helpful. A lot of people think about venture firms or private equity, raising from wealthy people and having their LPs being a lot of, rich families, family offices, things like that. But there's also a dynamic of this corporate VC notion that works within industries and specialties like EOS does, on the insurance side, which makes a lot of sense.
Right. I think what you're saying also is like, I'm going to touch on this, and I hope that everyone thinks I'm being polite when I say it. But I think there's a part of insurance companies' culture that is like by necessity conservative and I don't want to say slow moving, but very intentional. And you have these companies
They're risk averse.
risk averse, right?
Yes.
And you can only survive 100 or more years because you have that intentionality. And it's in many ways like a culture driven by the actuaries. And that's wonderful because it's one of the very few products where you don't know your COGS until potentially years after you sell the product. And so, an aggressive insurance company doesn't tend to last in the landscape very long. But that necessarily means that sometimes when you're pushing the edge of what innovation looks like, whether that's using new AI tooling, whether that's reaching a new customer segment, whether that's incorporating a different type of underwriting, sometimes you can access the people at the forefront of that better through an external partnership with an early stage company rather than incubating that internally. Just because very often the culture of these large carriers, I think just sometimes can face a lot of challenges with with like a test and learn sort of faster tech culture.
Yes, exactly. I explain that to people all the time when I talk about like some of our challenges. Our insurance partners are fantastic, but they're also, as you're explaining, by nature, risk management companies, who aren't necessarily at the forefront of doing the latest things. And like you said, this kind of relationship that they might have with a firm like yours at EOS gives them a way of bringing in some outside expertise on helping drive innovation within their industry, while at the same time providing some diversification within their investment portfolio into different alternative assets.
David, you say it better than I could. Thank you.
Yeah, we both live it every day. Maybe I feel the pain of the risk aversion of the carriers a little more acutely. It benefits you, and it hurts me. I've got to work through it. It becomes a driver of your business. But that's one of the things, as we work to drive innovation in the insurance carrier space, and it's part of their risk averse nature, is the commission world has always been what's driven, is still largely what drives the annuity and life insurance space. And at the same time, in the financial advisory world, it's really moved away from commissions and into fees. People are working on advice models, not sales models anymore in terms of the firm. And that's where we kind of, sit in helping drive that innovation within the annuity space.
Yeah. So let's talk like why DPL,
Yeah.
because I think that's a great topic. And I love talking with other people about how we found you guys, what excited us. Maybe to give the listeners a bit of context, we led your Series C in late 2024. And so are some of the newest institutional investors in the company. What we really like as like a broader sort of investment standpoint is we love when a company is hitting a macro and meets that macro with a really sort of unique perspective or edge.
Mm-hmm.
Like, in other words, they're able to answer why now and why me in a very compelling and unique way. And when we met DPL, we felt like you met that perfectly. And so from a macro standpoint, you're hitting on this phenomenal macro around annuities as well as RIAs. And then from a micro standpoint, you guys have the technology, the distribution relationships, the carrier relationships to like really make that happen. So like maybe let me talk about that
Yeah.
in a little bit more detail. So like from a macro standpoint, annuities, I'm sure your audience is like so familiar with this, but like we are ripping in terms of annuity sales. Like the last 4 years have been record sales driven by sort of peak demographics in the US. Between like 2023 and 2028, people 65 and older will grow by nearly 10 million. We think there'll be around 70 million retirees by the turn of the decade. These retirees, they want stability, they want income protection, and annuities are the perfect tool for that.
Yep.
So you have this enormous generation that's retiring that doesn't have pensions and that's seeking for a way to sort of protect their income going forward. And the annuity is frankly one of the only solutions available to the everyday American when they're thinking about what's that replacement for the traditional company pension.
That's right.
And I think it's a phenomenally fit product. And carriers have also been releasing a lot of very interesting and helpful iterations to, when you're thinking about someone's appetite for growth, someone's appetite for protection, you can really find what you seek within the newer annuities that are being released now.
Yeah. And annuities, they're so divisive, and they shouldn't be. And they're divisive because of the commission. And of course, when it started, that wasn't so divisive, but just the way the world has evolved, where you've got these diverging business models of advisors who still accept commissions. Very few still work on commissions alone, but they'll still use insurance on a commission basis. But everyone's moved to the asset management side and doing it on fees for advice. And so annuities, in the course of that change in the advisor's business model, have become pretty divisive because you can't get paid traditionally if commissions were the only available option. So we kind of remove some of that conflict and some of the issue with being able to use annuities in an advice model and still just include it as a piece of AUM. And it doesn't have to be that divisive thing, which is terrific for the end client because they are really powerful, as you're talking about, retirement products, which meet unique needs. And if you're just working on investments alone in an advice model, you're really lacking in your tools to meet retirement needs.
Absolutely. And that's the other macro that we felt like you guys hit really well, which is the growth of the RIA channel and the advisor as a fiduciary. And this idea that like it no longer makes sense for the consumer, but also when you're thinking about your practice long term for your sale value, to base most of your revenue on commission earning products. It's very hard for the individual to say, hey, am I getting the best advice out there if you have a conflict of interest here? And so we've been seeing just increased appetite towards that channel and towards the fiduciary model. But then that means they need a specific annuity product for that. And that's the fee-based annuity, which has been growing in popularity recently, but still, frankly, we think isn't where it needs to be in terms of the true appetite for this asset class.
Yeah, agreed. And we're seeing some movement in that because we're still relatively new into this whole notion that there's a fee-based marketplace of annuities rather than just commission. And so it really starts to, again, get reinforced by the advisor's business model. If you're in an advice relationship with your client for 99% of what you're doing and talking to them about, it's really odd then to go into, let me put my salesperson hat on now in the middle of a conversation. And basically now I'm acting as an appointed sales rep of an insurance carrier outside of our advice model now. And now I think people are catching up to the fact, both from like compliance people at the big RAs we work for and FINRA and other people catching up to like, that doesn't seem right. And that seems like you should at least be considering fee-based products and keeping the advice model complete with your client rather than switching hats on rare occasion to sell a product, which doesn't really seem to make sense.
Oh, completely. Yeah. It always also surprises me how many financial advisors are able to have a conversation about asset management without having a conversation about asset protection as well. I know we're talking right now about the annuity side of your platform, but you guys also have a rapidly growing insurance platform as well that has wonderful products around term, around permanent life, around long-term care. And it's just very surprising to me how few financial advisors are willing to look at the opposite side of that coin and say, hey, what if something happens to your life? Let's talk in a more holistic way about how we should be protecting your assets and your family going forward. And that should be a single conversation. You shouldn't be handed off to someone different or handed off to a different way of making money when you start having that broader conversation.
That's right. And I think that's an evolution too. When you talk about the macro trends, when I started in the RIA business 20 years ago, RIAs were asset managers. And most financial advisors were more asset managers. And now it's becoming that they're more holistic planners around protection, around estate planning, tax planning, encompassing your whole financial life. And you're seeing the growth and size of firms that are supporting their clients, and they're becoming these massive firms with all kinds of capabilities. And so it makes sense to have it all in one place. And I think that's also driving a lot of our success. In what we're seeing is advisors need to provide more than just asset management these days. They need to be looking at insurance and protection and estate planning and all of those things. And one of the other things that's important about it is putting it all together into their desktop. So it's not all this disparate relationships and technology and data feeds that they've got to try to manage. And so that's one of the other things we really try to drive is that integration and deep embedding of our technology into the advisor's desktop, which we think is really important for them to deliver the completeness that they need to for their clients.
Yeah, I love what you're saying here because that sort of dovetails with, we love the macro of annuities. We love the macro of the RIA segment. But then you guys came in and you said, hey, we have relationships with more than 2/3 of the sort of accessible advisor universe through these like main technology partnerships with Orion, with Black Diamond, with Tamarack, and that we are uniquely able to sit within their technology stack. We have the carriers on this side, we have the advisors on this side, and it's not a separate conversation to talk about income or life protection within that discussion. And that to us was a really key feature when we were like, who is going to win in the market? The person who's going to win is the person that sits at the middle of the existing ecosystems and is able to speak in the language of the advisor through those portals. And to make that sale almost as easy as a mutual fund sale, which is
That's where we're driving.
maybe that's a little bit aspirational. It's a complicated product, but like those were really the things that excited us about DPL and why we've been so thrilled to join the company on its growth journey.
That's terrific. And that's awesome. And what else are you seeing in the market that you think's interesting, and particularly as it may pertain to advisors and their businesses? What other kind of innovative things do you see in the market?
We're seeing a few sort of themes of interest that VCs are really leaning into around the AI wealth space. One is like the tech-enabled RIAs. You have like Further Finance, Savvy Wealth. These guys are sort of building their own tech platforms from zero. There's a lot of interest in terms of bringing on new advisors to the platforms. I've heard they've been relatively aggressive in this space in terms of what they want their growth to look like. There are also a wealth of AI note takers. And you might be like, oh, an AI note taker, that's incredibly boring. But actually, if you think about it, they're actually a really important part of the ecosystem. If you can have a note taker sit there, listen to your meetings, integrate into your CRM, complete a lot of the next steps that have to happen, pre-draft your emails, follow up automatically. So it's not just a note taker. It's almost think of it like an executive assistant within your computer. And so, these are relatively early in terms of like actually the full cycle that they aim to take over. But Jump, Zox, these companies are really, let's say, raising heavy rounds as well as growing quite aggressively in the wealth management space. We're also seeing a lot around tax optimization.
Mm-hmm.
And so both from sort of a small business standpoint, a high net worth standpoint, an individual standpoint, being better able to sort of automatically review your past filings, flag audit risk, help the everyday advisor have a more tax forward conversation before they bring in a professional. So that way they can begin sort of adding value immediately and then really sort of like teasing what a broader relationship could look like.
Yeah, that's great. Like you said, it's a great time from a price point on AI. Where do you think that's going to go, though? It's not always going to be like this. And how would firms utilizing AI kind of protect themselves from getting deeply in bed with some AI technology, driving their business? Now, all of a sudden, it's quite expensive. Like, where do you think the pricing is going to go? How are they going to get you? ultimately.
So this is something that we worry about when we think about investing in the space, which is why we haven't made a big AI bet yet. And I think there's one question, which is what's the long-term advantage of these tools? You saw last week a few of the large language models introduce their own like AI legal assistants,
Mhm.
which makes you really question the value of some of these large funded companies like Harvey and a few others. If the foundational models are going to do vertical SaaS services as well, what does it look like to be building sort of a thin layer on top of them? What's the real long-term advantage here? And so I do think there's a world in which maybe some of these foundational models start providing these services directly. Maybe cost continues to be low, but maybe if I were an advisor, I would keep my core technology stack with my like traditional players,
Mhm.
with my Orions, with my Black Diamonds. They're here today. I'm very confident they're going to be here in 5 to 10 years. They do a wonderful job. And then I would selectively augment in a sort of very plug and play way with some of these more AI native solutions.
Mhm.
And so that way, if my note taking app in 3 years gets acquired or goes out of business or something happens, I can find a new one. But I'm not necessarily shifting my full technology stack to a company that was started 12 months ago by an 18-year-old who spun out of OpenAI.
Yes, even if that 18-year-old's now driving 100 million in revenue.
Well, I mean, David, you actually, once you start digging into these companies, though, you would be astonished by the levels of churn in some of them.
Mhm.
That everyone is willing to pilot, everyone will kiss around, but when it actually comes to getting married and signing a contract,
Yeah.
we're seeing a lot of churn in some of these companies. And so I would also highly recommend piloting before serving a long term contract, because I think sometimes the accuracy in some of them might be very compelling. It might get you 85% of the way there. You really have to ask yourself as a business, are we okay with 85%? Does that fit the use case we need? Or are we sort of losing some of the fidelity that really makes our high touch relationships important?
Yeah, and the evolution, it's things that are state of the art today are literally obsolete 2 months from now, right now. I mean, it's just evolving so fast. Making long-term commitments doesn't feel right right now. You've got to remain nimble and continue to spec out the market.
And I think the final thing that concerns me when I think about the AI boom, specifically when it pertains to vertical software, like software for the insurance industry or for the wealth management industry, is even though it's great, even though it's useful, will we get dramatically different exit multiples than we've historically seen in this space? Right? Like a lot of the attention around AI has people talking about foundational models. And of course, you can get stratospheric valuations there. And then you also can think about sort of new markets like data centers in space. I don't know how you value that, but I'm assuming you can value that a lot more aggressively. But like when I think about, a traditional wealth tech player, there's a defined market for this. There's a clear buyer universe. There are clear private equity sponsors. I think on the insurance side of this, we really saw this when Willis Towers acquired Newfront earlier this year, which went for 15 times adjusted EBITDA, which is exactly what most brokers typically trade for.
Right.
And so there was, sure, there was probably some premium baked into that quote adjustment when you think about what the tech was actually worth, but you're not seeing Newfront go for 30 times EBITDA. You're not seeing it go for 40 times.
Right.
You're seeing these trade to traditional players at traditional or slightly higher than traditional multiples, which really makes me think, it's really hard to redefine your exit universe. And so if I buy in at a valuation which is beyond that universe, how can I believe in a new reality going forward and what would be needed for that to happen? And I would say we still haven't seen enough proof points to fully believe that when we look at the vertical SaaS space in these areas.
Interesting perspective. Appreciate
It's a bit of a bummer perspective, but but I have to say, I think it's a perspective that'll make me a little bit more money than some of the other sort of high flying big dreamers out there. So maybe can I talk about some things I like?
Sure.
Because I've talked about things I don't like.
Yeah.
Okay. Things that excite us right now are, I would say, a few areas. One, retirement and deaccumulation,
Hmm.
which definitely aligns with you guys. But I think there's a broader question that like the US market is facing, which is as we move from defined benefit to defined contribution, how are people managing deaccumulation within their 401ks?
Mm-hmm.
And I think we're seeing record keepers often lose those assets. I think we're seeing people often individually manage when they ought not to be individually managing.
Yep.
It's so funny. People actually don't tend to run out of money. It's that they tend to underspend the funds they have available due to excess conservatism.
Yes.
And I think we as a country haven't been able to compellingly answer, like, what is our new retirement scheme and what are the supports people have to appropriately manage that large nest egg?
Yep.
And so I'd love to see more solutions there. We're very interested in that space.
Yeah, that's again, annuities play into that space. And we hear it from our advisors directly that it enables, and you see it in the academic research, having an annuity enables people to spend more freely in retirement because they know that they've got that backstop. They don't have the fear of running out of money. It doesn't have to dominate their thinking throughout their retirement. They know that they've got essential expenses covered by guaranteed income through Social Security plus an annuity, maybe if they've got a pension, but it just enables that freedom of spending, which, as you say, is the bigger problem. I was, I don't know, a year and a half ago in a room of a couple hundred advisors, and whoever the academic leading a discussion said, among you, how many of you as financial advisor, your bigger problem is getting people to spend in retirement or getting people to not overspend in retirement? And it was like 3 hands went up for I've got to prevent my people from overspending. It's all they don't spend what they could be or should be spending in retirement. And that is a challenging problem and issue, and solutions around that are certainly interesting and not easy.
Yeah. I mean, I think people understand how to spend a paycheck,
Right.
but they don't understand how to spend a lump sum appropriately.
Right.
And it just creates a suboptimal retirement, compared to what people deserve.
Right. And that's why like an annuity is almost a replacement like that. So, we talk a lot about the economic benefits of an annuity, but the behavioral ones are also important because you go from, however much time, 40, 50 years you spent working and, to your point, getting a paycheck. And you're very used to that paradigm. I know how much money I have to spend. I have my budget. I'm not dipping into my savings and seeing my nest egg dwindle. And now an annuity can replace your paycheck. And just behaviorally, that's a lot easier to understand rather than having to go to my financial advisor and say, how much money can we generate here this quarter for me to spend, and seeing that coming out of my portfolio, and maybe it's not a great time to sell. There are just so many other benefits to annuities where that's part of what we get excited about working with advisors for, all those traditional advisors who've been fee only, investments only. Now we've got a way of starting to get them to pay attention to annuities and start learning about all the benefits again.
Absolutely. So in addition to this sort of deaccumulation question, we are also very interested in the intersection between wealth and insurance.
Mm-hmm.
And long-term care, I know, is part of the DPL platform, but I think there can be so much more done in long-term care across the industry. Carriers have really redesigned what long-term care products look like, so they're much more sustainable and accessible for the everyday consumer. I know Washington State has stepped in and mandated sort of long-term care, and that sort of typically comes out of your paycheck. California is debating it. And then just when you look at individuals' spend over time, having a health event later in life and getting into sort of an at-home care or facility care situation is one of the greatest destroyers of wealth.
Mm-hmm.
One of the largest reasons that people aren't able to appropriately pass down certain targeted assets to their children. I'm not sure the right answer to this, right?
Yeah.
But when I look at it and I look at the purchasing behavior of long-term care, when I look at carrier appetite here, there's a lot of potential, but we're just not seeing advisors yet able to sell long-term care in a compelling way.
Yes.
And maybe that's better illustrations. Maybe that's a improved product experience, but I just wrestle with how to unlock such a valuable product for more Americans.
Yeah. And it's one, I know we've talked about it before. It's one of the ones we hear from advisors. It's among the most interest, other than some of the core annuity offerings. Long-term care is probably the next one. Everybody wants to know about it. Everybody wants to know what the options are, but very few people act on it. They go into, my client will just self-insure on long-term care, which everybody uses that term, and technically you actually can't do that. You mean you're just going to cover the costs yourself. You're not actually self-insuring. But it's a tricky one because it's very much like longevity risk in some ways, because you don't know what the period is you're trying to plan for. Is this going to be a 2-year long-term care stay? Is this going to be a 15-year long-term care stay? Much like longevity, you just don't know how to prepare for that or plan for it. So that's really a great use case for insurance, right? When you have an undefined risk, that you don't know what the magnitude can be. I think advisors are kind of kicking the tires and exploring more. And I do think it's a very natural use case for insurance. And I would hope that more start taking up the use of insurance in those plans rather than kicking it to, we'll cover the cost, within the portfolio. Because like you said, it can completely destroy wealth, a long-term care stay.
And speaking of completely destroying wealth, I also wish more financial advisors would have a more holistic discussion around traditional P&C products. And I know many people are just like, oh, home auto, like go to your local personal lines agent. It sort of isn't worth my time. But when you actually look at the risks people are exposed to, your advisor ought to have a better perspective on this.
Yes.
Like, for instance, I used to live in California. I work in insurance, right? And it wasn't until I chatted with a friend where I was like, oh my gosh, my UIUM, my uninsured motorist coverage is far too low, given like 25 to 30% of LA drivers are under or uninsured. And I jacked that up the next day. I sat back for a second and I was like, why has no one tried to sell me umbrella? I should have gotten an umbrella years ago. And, it really makes you think like, yeah, my typical P&C agent is going to give me a really basic home and auto policy and call it a day. They're going to make my mortgage carrier happier. They're going to make the state regulator happier because I'm going to be insured appropriately. But the point is, when you have a holistic view of someone's assets, you're able to see, hey, actually, you really need a more comprehensive portfolio of coverage, because given the litigation environment that we have in the US and the number of uninsured motorists or the number of liability events, you're significantly leaving yourself exposed if your P&C coverage doesn't have sort of basic elevated limits in certain areas.
And we're seeing a little bit of that happening within firms, not too much though. And I think mostly like advisors don't want to be the front line of a claim. So you've got an auto claim, you're calling your financial advisor, and that they don't want to be in that spot. But like you said, it's an important part of risk of your financial well-being, making sure you're properly insured in all the various aspects of your life.
Absolutely.
Well, Galen, this has been fantastic. Appreciate your time and your thoughts. And it's been a really great conversation. I don't know if there's anything you want to leave our listeners with, or in general.
Well, appreciate you having me here. Thanks for having me participate in this conversation. It's great to chat, David.
Thanks, Galen.
Thanks for listening. To hear more advisor revelations, go to dplfp.com and subscribe on your favorite podcast streaming app.